Hey guys, this is Jack Bevere at Dominion. I wanted to record a quick video for you to talk a little bit about and hopefully make a little bit easier to understand the Treasury yield curve and how it affects your real estate investing business. I'm going to share my screen real quick here and go to a website that I found is pretty neat. It's USTreasuryYieldCurve.com. It's a neat little app where you can go in here. It's very simple to use. You can see what the Treasury curve looks like, and you can plug in any date that you want. So the Treasury curve is simply a graph that shows how much it costs the US federal government to borrow money for different periods of time. So right now, if you want to lend, if the US government wants to borrow money for just 1 month, they're willing to pay a 3.57% interest rate. Or rather, the market requires them to pay a 3.57% interest rate. If they want to borrow money for 6 months, it's 4.5%. A year is up to 4.6%. Weirdly, and concerning, and it's concerning that beyond a year, it actually costs the federal government less money to borrow for a longer period of time, which isn't normally the case, right? More time that you're borrowing money for, there's more risk to that time. And so in a normal environment, this curve is shaped like that, where you want more time, great, it's going to cost you more for that more time. But right now, the market perceives so much risk over the course of the next year that the 1 year rate is actually the most expensive point on the curve. This is what's referred to as an inverted yield curve. I'm sure you've seen that in the news. Here's something I want to point out to you though. So the 1 month is here at 3.5%. The 1 year is at 4.6%. Let's go back in time just a little bit and see where this was just a couple months ago. So our 1 year is at 4.6%. That's our reference point. We go back just to July. The 1 year was 2.8%, almost 200 basis points, 2% less just 3 months ago. And the curve looked a lot more normal. It was getting flat in the middle. People were getting concerned, but it was far from inverted. Go back a couple months prior to that, back to say March, and the 1 year is down at 90 basis points, 0.9%, and it's a normal looking curve. So just 7 months ago, if there was any opportunity to, the treasuries are about the most liquid, widely traded security in the world. And that over the course of less than a year, we can go from 0.9% to 4.6% in 1 year is a humongous change on the value of those securities and on the world's perception of risk, and what the risk-free rate should be, which is US Treasuries are essentially the risk-free rate. If you go back even a little bit further, back to January, the 1 year is down at 0.4%. All right, so great, bunch of nerdy finance stuff, but how does it affect your real estate investing business? So for everyone who was borrowing hard money loans, or is borrowing hard money loans or bridge loans, fix and flip for their fix and flip projects, those are generally your lender. Those are 1 year loans, and so the reference point is the 1 year Treasury yield. So a year ago, not even a year ago, 10 months ago, that reference point was 0.4%. And so you were being priced off of that risk-free rate of 0.4%. And that has gone up, as we said, to 4.6%. So it's gone up 4.2%. So if your bridge lender has raised you less than 4.2%, you're not actually getting all that bad of a deal right now. For everybody who's borrowing DSCR, because their cost of capital, your lender's cost of capital has gone up by over 4% over the course of the last year. So lenders are not trying to raise rates like that because they don't want to lose customers. we're going into a recessionary environment, and lenders are concerned about, declining volumes generally in the world. And so if they start raising rates on their existing book of customers, the customers start to shop. And so lenders have been reluctant to raise rates as quickly as this curve has gone up over the year. But and it's just kept climbing every couple months. It just keeps climbing. But it's really gotten to, at this point, it's kind of gotten to the breaking point. So we're seeing a lot of capitulation by lenders where they're just starting to, they have to raise rates. And so we're seeing that in the market right now. The other way that it might be affecting your business is if you're borrowing DSCR loans, the debt service coverage ratio underwritten loans for landlords, whether that's a 30-year loan or a 5/1 ARM. Those loans generally are being priced off of the 5-year. The reason is that historically, those loans have paid off in an average of 5 years. And a lot of those loans being written right now have a 5-4-3-2-1 prepayment penalty structure. This is one of the reasons that if you ask for a 3-2-1 prepayment penalty structure, the loan costs you a little bit more because one, the bondholders want the duration, and actually the 3-year is ironically above the 5-year right now. So, but even last year when there was a normal shaped yield curve, the DSCR loans were being priced off of the 5-year. And so right now that 5-year is at 4.36%. Again, if we go back 3 months ago, the 5-year was only 2.88%. And if you go back a couple months before that, the 5-year was 2.1%. And if you go back to January, what I'll call the good old days, it was at 1.4%. So your loan was being priced off of this as the reference point. And now that reference point is almost 300 basis points higher, which is why we went from 5% DSCR loans to 7 and even 8s in some situations, DSCR loans. And additionally, there's been some volatility in the market. And so lenders they've gotten burned because they kept thinking that the whole year, everyone, every 3 months, they're like, all right, that sucked. But at least that was the worst of it. That's over. And so, you know what? These yields are much higher now. This is a great yield. We're going to start buying these DSCR loans. And every time they did it, the rates just kept going up and kept going up, which means they made a bad investment, right? If you're a bond buyer and the rates keep going up month over month over month, you're the guy who put his money out too soon. And the value of what you bought went down over that period of time. And so people just, the lenders who were making DSCR loans just kept having getting burned all year. Whoever ended up buying that loan ultimately and holding it just kept getting burned because rates just have continually gone up. And so as a result, they're like being a little bit conservative about their pricing because they're afraid the market could continue to keep going up. And so not only are we, as real estate investors, are we getting hurt by being priced off of a higher and higher 5-year Treasury reference point, but we're also the people who are ultimately writing those loans, owning those loans, are requiring a little bit more premium, a little bit more spread because they've been catching a falling knife all year. And so we're seeing that's another reason that we're seeing increases in pricing. So it's kind of double trouble, both higher index reference point as well as a higher credit spread, which has been just terrible for DSCR pricing all year. We'll see what happens over the course of the next 6 months. Hopefully we've reached a peak, but people have said that a lot of times this year and lost money after uttering those words. So we'll see. The other reference point, conventional mortgages like residential consumer loans are priced off of something that's a little bit longer than 5. It's somewhere between the 5-year and the 10-year, depending on the nature of that conventional loan. And so for those who are closely following consumer residential mortgage rates, when you're referring to this graph, you'll want to refer to probably maybe the 7 as a decent reference point for how the consumer residential mortgages are priced in the broader market. So anyway, just thought wanted to share that tool with you guys. It's kind of hard to Google and find a great resource for US Treasury yield curve, and certainly one where you can go back in time and think like, all right, hey, I got that quote from a bank 4 months ago. It was definitely a lower rate, but that's, the right way to think about that is what's the credit spread over the treasury, the appropriate treasury at that time. So you should really be thinking about all of your loan quotes from whatever lender as a function of the credit spread over the appropriate treasury. So if it's a 2-year loan, how much is it above 4.5%? If it's a 5-year loan, how much is it over 4.36%? And if it was a quote from 3 months ago, well, then go back 3 months, go back 3 months ago and figure out what that credit spread was. That'll tell you if it's a good deal or not, because the lenders really cannot control what the treasuries that they're pricing off of are, but they can control what the credit spread is, which is the risk premium that they're charging you. So you want to be, as a borrower, you want to be minimizing that risk premium. Look for the lender who's going to charge you the lowest risk premium relative to the amount of time that you're going to borrow the money for. So you're looking at a 10-year loan. It's right now it's let's go today. You're looking for a 10-year loan. Right now, it's the reference point is 4.25%. So you get a 6.5% quote from a bank. That would mean that they're charging you 2.25%, 225 basis points of risk premium above the 10-year. And that 225, that's the number that you should be comparing to alternative quotes. Someone gives you a 7-year quote and you're trying to compare apples to apples. Well, that's the way to do it. 6.5 for 10 years is 225 basis point premium. 6.6 for a 7-year is 229 basis points of risk premium. So that 10-year deal, even though the rate's a little bit higher, is actually a better deal because the credit spread is lower. That's the way to look at that. Anyway, I hope that's helpful. It's a cool app that I refer to all the time. It's been one that I've been referring a lot to this year as interest rates have been going up and up and up. And hopefully that's can help you make the best decisions for your real estate investing business. Thanks again for your time. Great to see everyone. Have a good one. Bye.